Welcome to the Deep Dive. Today, we're going to be tackling a question that I bet a lot of you have. How do you build a killer investment portfolio with ETFs? You know, even if you're only starting with like $2,000.
Yeah, that's a great question. It's one that we get a lot. And luckily for us, we've got some excellent insights from the Motley Fool to help guide our deep dive today.
Okay.
James Brumley's article, 3 Vanguard ETFs to buy with $2,000 and hold forever, really digs into some simple but powerful strategies.
Yeah, I love that hold forever part. It makes investing feel less like, frantic day trading and more like you're building something, solid for the future. But let's be honest, the investing world can feel really intimidating, even with ETFs.
Yeah, it definitely can. There's just so much jargon out there, so many options.
Right.
But this article does a great job of cutting through the noise and focusing on like a core idea. You don't have to be a Wall Street wizard to invest successfully.
Okay, I'm intrigued. So where does this simpler approach begin? What's the first ETF on our list?
The article kicks things off with a classic, the Vanguard S&P 500 ETF.
Okay.
It's also known by its ticker symbol, VOO.
Okay.
It's basically like buying a tiny slice of the entire S&P 500 index, which tracks 500 of the largest U.S. companies.
See, even I know about the S&P 500, and I'm no expert. But honestly, I always kind of figured that tracking the market was kind of, boring. Wouldn't I be better off trying to pick, like, hot stocks and stuff?
Yeah, that's a common misconception.
Yeah.
It turns out that most investors, even professional investors, actually underperform the market by trying to beat it. Think of it like this. Imagine you're trying to outsmart, like, 500 of the biggest, most established companies in the world. The odds aren't exactly in your favor.
Okay. So instead of playing stock market roulette, I could just ride the wave of the overall market's growth with VOO.
Exactly. And there's data to back this up.
Okay.
Standard & Poor's found that over the past 5 years, a whopping 77% of actively managed funds,
Wow.
those run by supposed experts, did worse than the S&P 500. VOO essentially puts you on the same playing field as the market itself.
That's a pretty convincing argument. But let's say I'm sold on this whole VOO idea. Why wouldn't I just buy into the S&P 500 directly? What's the advantage of using an ETF?
That's a great question. So an ETF bundles all those companies together into a single investment that you can buy and sell just like a stock.
Okay.
Plus, ETFs, like VOO, usually have super low expense ratios. Think of it as a tiny fee you pay for the convenience of having a diversified portfolio in one package.
Okay, so I'm hearing diversification is key, and an ETF makes that easy. But hold on, you mentioned expense ratios. What's a good expense ratio, and what does VOO charge?
A typical ETF might charge you around 0.25%, meaning you pay $2.50 in fees for every $1,000 you invest. Now, VOO comes in at a remarkably low 0.03%. That means for every $10,000 invested, you're only paying $3 in fees.
Wow.
Over time, those savings can really add up.
Yeah, I'm starting to see why this keep it simple approach can be so powerful. You're minimizing fees, you're getting that broad exposure to the market, and you're not stressing yourself out trying to pick winning stocks. It almost sounds too good to be true.
There's definitely a peace of mind that comes with this approach.
Yeah.
And that's the beauty of the kind of buy-and-hold strategy that the article emphasizes. You're in it for the long haul. You're riding out any sort of short-term market fluctuations.
Okay. All right, so VOO is all about establishing that solid foundation for our portfolio. But what if we want to spice things up a bit? Is there an ETF that could add a little extra zest to our investments?
There is, and this is where things get really interesting.
Okay.
The Motley Fool article next introduces us to the Vanguard Dividend Appreciation ETF, also known as VIG.
Okay.
And before you zone out at the word dividend,
Okay.
trust me, this one's worth paying attention to.
I'll admit, when I hear dividend, I picture my grandparents clipping coupons. Not exactly the most thrilling image, but hey, I'm open to being persuaded. What's so special about VIG?
Okay, imagine this. You own a rental property, and you have a tenant who consistently pays rent on time and even offers a little extra each year. Wouldn't you love that tenant?
Of course. Reliable, increasing income. Sign me up.
That's exactly what VIG does. It invests in companies with a long history of not only paying dividends, but consistently increasing those dividends over time.
Okay.
Think of it like having a portfolio full of those amazing tenants, all steadily paying you more each year.
Okay, that analogy makes a lot more sense than clipping coupons. So it's not just about getting those dividend checks, it's about the potential for those checks to grow significantly over time. Now we're talking.
Exactly. And the numbers back this up. VIG's dividend payments have actually doubled over the past decade.
Wow.
And companies that consistently raise their dividends tend to outperform the market as well. It's like a built-in growth engine for your portfolio.
So if I'm understanding correctly, VIG offers kind of a double whammy, the potential for stock price appreciation and a growing stream of dividend income. Not bad at all.
Not bad at all. And there's even more to the story. Since 2006, VIG has nearly tripled in value.
Wow.
But here's the kicker. If you'd reinvested those dividends along the way, your returns would have jumped by an additional 44%. That's the power of compounding in action.
Hold on. 44% extra just from reinvesting those dividends? That's incredible. Suddenly dividends are sounding a lot less like a grandpa activity and a lot more like a secret weapon for building wealth.
They really can be. And what's great is that with VIG, you have the flexibility to choose whether to reinvest those dividends or take them as cash. So if you need the income now, you can take it. But if you're playing the long game, reinvesting can supercharge your returns.
Okay, so VOO helps us build that solid base. VIG adds some dividend-powered growth potential. But I can't help but wonder, where does the exciting, cutting-edge tech world fit into all of this? Surely there's an ETF for that too, right?
Absolutely.
Yeah.
The final ETF in our lineup is one for those of you who are drawn to the fast-paced world of technological innovation.
Okay.
It's the Vanguard Information Technology ETF, or VGT.
Oh, okay.
And it gives you exposure to the entire tech sector, from established giants to up-and-coming disruptors.
No, that's what I'm talking about. But honestly, I always thought picking individual tech stocks was a bit like playing the lottery. You never know which companies are going to explode and which ones are going to, fizzle out.
It's true. Picking winners in the tech space is notoriously difficult, even for seasoned investors. With VGP, you don't have to worry about choosing individual stocks.
Okay.
You're essentially betting on the continued growth and innovation of the entire tech sector.
So instead of trying to predict the next Apple or Microsoft, I'm basically riding the overall tech wave with VTT. That sounds a lot less nerve-wracking. But let's be real, tech can be volatile. Aren't I just setting myself up for a wild ride?
It's true that tech can be more volatile than, say, the S&P 500. But remember, technology is constantly evolving and reshaping the world around us. It's hard to imagine a future where tech doesn't play a major role.
Yeah, that's a good point. Even if there are ups and downs, it seems like betting against the long-term growth of tech would be, pretty foolish.
Right.
But how do I know which companies VGT is actually investing in? Does it just stay the same, or does it change over time?
That's one of the great things about ETFs. VGT isn't static.
Okay.
It's constantly adjusting its holdings to reflect the most promising players in the tech industry. Right now, its top holdings include Apple, NVIDIA, Microsoft, and Broadcom. But in 5 or 10 years, those could be totally different companies.
So I'm not just getting exposure to today's tech giants. I'm also getting a front row seat to the evolution of the entire tech sector. That's pretty cool. But I have to ask, if tech can be so volatile, how do I avoid getting caught in a sudden downturn with VGT?
That's a smart question, and it brings us back to the importance of diversification. VGT gives you exposure to a wide range of tech companies, so you're not overly reliant on the performance of any single stock.
Okay.
If one company stumbles, it's less likely to drag your entire portfolio down.
Okay. So VGT is all about spreading that risk across the entire tech sector, which makes sense. But I have to admit, the thought of tech's volatility still makes me a little nervous.
That's understandable. But think of it this way. Remember those old school flip phones? They were cutting-edge technology once, but they've been completely replaced by smartphones. That's the beauty of tech.
Yeah.
It's constantly innovating and pushing boundaries. VGT allows you to participate in that exciting journey, even if it comes with some bumps along the way.
I see what you mean. It's like the old saying, no risk, no reward.
Right.
But what if I'm not comfortable with a lot of risk? Should I just steer clear of VGT altogether?
Not necessarily.
Yeah.
Remember, building an investment portfolio is all about finding the right balance for you. Maybe a smaller allocation to VGT makes sense, while a larger portion goes to a less volatile option, like VOO or VIG. It's all about customization.
That makes a lot of sense. So we've got VOO for a solid foundation, VIG for dividend-powered growth, and VGT for tapping into the world of tech. It's like building a delicious investment sundae with different flavors to suit your taste.
Right.
But before we start scooping up those ETFs, is there anything else we should consider?
There is. We've talked about the different flavors, but now we need to think about the right proportions for our sundae.
Okay.
How much of each ETF should we actually include in our portfolio?
You're right. That's a crucial question. And that's where things get really personalized, right? It's not a one-size-fits-all situation.
Exactly. Your risk tolerance, investment goals, and even your age play a huge role in determining the best allocation for you.
Okay, so we need to factor in how much risk we're comfortable with, what we're hoping to achieve with our investments, and how much time we have to let our investments grow. It's like a three-legged stool for making smart decisions.
You got it. And remember, the Motley Fool article frames this whole discussion around starting with $2,000.
Yeah.
That makes these strategies accessible to a lot of people.
That's what I love about this approach. You don't need to be a millionaire to start building a diversified portfolio with ETFs. But how do we actually go about dividing that $2,000 across VOO, VIG, and VGT? What are some potential scenarios we could consider?
Let's start with someone who's, a bit younger, maybe in their 20s or 30s, and has a higher tolerance for risk.
Okay.
They might be comfortable putting a larger chunk of their money, say 60%, into the potentially high-growth tech sector with VGT.
Okay, so 60% for VGT. What about the remaining 40%? How would you divvy that up between VOO and VIG?
A good option might be to allocate 25% to VOO for that broad market stability and 15% to VIG for a dose of dividend-powered growth.
Okay.
This approach gives them like a good balance between growth potential and that core of stability.
That makes sense. But what about someone who's closer to retirement, maybe in their 50s or 60s? Wouldn't they want a different mix?
Absolutely. Someone nearing retirement might be more focused on preserving capital and generating income. They might prefer a larger portion in VOO, maybe even 50% or more, for that steady, reliable growth.
Okay. So for someone who's more risk-averse, we might shift the proportions to favor the S&P 500 with VOO. But how would we incorporate VIG and VGT into that mix?
Well, in this case, we might reduce the allocation to VGT to something like 10% or even less, depending on their comfort level with tech's volatility.
Okay.
And we could bump up VIG to maybe 30% or 40% to provide a stream of dividend income.
So for someone closer to retirement, it's all about finding that sweet spot between stability, income, and a little bit of growth potential. It's fascinating to see how those proportions can shift based on, individual circumstances.
That's the beauty of it. There's no right or wrong answer, just different approaches based on your unique needs and goals.
Right.
And remember, these are just examples. There are countless other ways to allocate your $2,000 across these three ETFs.
And we're not pretending to be financial advisors here. We're just exploring some possibilities and hopefully sparking some ideas for our listeners.
Exactly. The goal of this deep dive is to empower you to do your own research, explore different options, and ultimately make informed investment decisions that align with your individual situation.
I love that. It's like we're giving our listeners a toolbox filled with, knowledge and strategies, and they get to decide which tools to use and how to build their own, unique investment masterpiece.
I like that analogy.
Yeah.
And speaking of masterpieces, the Motley Fool article ends on a really thought-provoking note. It asks how the landscape of these ETFs might change over the next 10 years. What emerging technologies could reshape the holdings of VGT, for example?
That's a fantastic question. It makes you realize that even with a buy and hold strategy, the world of investing is always evolving.
Absolutely. Think about it. 10 years ago, did we have widespread adoption of things like artificial intelligence, blockchain, or even self-driving cars?
Right.
The tech world moves at lightning speed, and those changes will inevitably be reflected in ETFs like VGT.
So even if we're not actively trading stocks, we still need to stay informed about the trends shaping, the investment landscape.
Exactly. Continuous learning is key. The world of investing is dynamic, and the more you understand, the better equipped you'll be to navigate those changes and make the most of the opportunities that lie ahead. Remember, knowledge is power, especially when it comes to your finances.
Well said. So to wrap things up, let's do a quick recap of our three ETF contenders. We've got VOO, the steady workhorse tracking the S&P 500, offering that broad market exposure and a solid foundation for any portfolio.
Then there's VIG, our dividend growth champion. This ETF focuses on companies with a track record of consistently raising those dividend payments, offering a compelling combination of growth and income potential.
And finally, VGT, our ticket to the exciting and ever-evolving world of tech. With VGT, you're not just investing in companies, you're investing in the future of innovation.
And the beauty of all three of these ETFs is that they're incredibly accessible. With just $2,000, you can start building a diversified portfolio that aligns with your risk tolerance, your goals, and your timeline.
And the key takeaway here is that it's not about picking the best ETF, it's about choosing the right ETFs for you and your individual circumstances.
Exactly. Investing isn't a one-size-fits-all endeavor. It's about taking control of your financial future and making choices that empower you to achieve your goals.
So what does this all mean for you, our listener? We've thrown a lot of information your way about ETFs, dividend growth, and, the ever-changing tech landscape. But we don't want to just leave you with facts and figures.
We want to inspire you to keep exploring, to keep learning, and to keep asking questions. Don't stop here. Take what you've learned today and delve deeper. Research these ETFs, explore other options, and, most importantly, think about how these investment tools can fit into your own financial goals.
I love that. Think of this deep dive as a launchpad, a springboard into the exciting world of investing.
Exactly. And remember, there are tons of resources out there to help you along the way. Websites like The Motley Fool, financial blogs, and even your local library can provide a wealth of information.
And don't be afraid to seek guidance from a financial advisor if you need personalized help. They can help you tailor an investment strategy that aligns perfectly with your individual needs and risk tolerance.
Absolutely. Investing is a journey, not a destination. It's about making informed decisions, learning along the way, and ultimately taking control of your financial future.
And as you embark on that journey, we want to leave you with a final, thought-provoking question. It's something the article touched upon, but we want to take it a step further. Think about the potential impact of artificial intelligence. How might AI reshape not only the tech sector, but the entire investment landscape in the coming years?
It's a fascinating question to ponder. Will AI-powered tools become the norm for managing portfolios? Will they disrupt traditional investment strategies? Will they make investing more accessible to everyone?
Those are all great questions, and the answers are still unfolding. But by staying curious, informed, and engaged, you'll be well positioned to navigate those changes and make the most of the opportunities that lie ahead.
Exactly. The world of investing is dynamic and full of possibilities. Embrace that dynamism, stay curious, and never stop learning.
And that, my friends, is a wrap on this deep dive into the world of ETFs. We hope you've gained valuable insights, sparked your curiosity, and feel empowered to take control of your financial future.
Remember, knowledge is power, and with the right tools and resources, you can achieve your financial goals and create a brighter tomorrow.
Until next time, keep diving deep, keep exploring, and keep reaching for your dreams. All right, so we've laid out our 3 ETF options, VOO for that broad market stability, VIG for the dividend growth boost, and VGT for riding the tech wave. But I think we need to get a little more specific here. Let's say I've got $2,000 ready to invest. How would I actually divide that up between these 3 ETFs?
That's where things get really interesting. Remember, there's no single right answer. The ideal allocation depends on your individual circumstances, especially your risk tolerance.
Okay, so let's play pretend. Let's say I'm a younger investor, maybe in my late 20s with a decent appetite for risk. How might that shape my ETF allocation?
Well, in that case, you might be comfortable allocating a larger chunk, say 60% to VGT. The tech sector has the potential for, explosive growth, but it also comes with more volatility. Since you're young and have a longer time horizon, you can afford to ride out those ups and downs.
So I'm essentially betting that the long-term gains in tech will outweigh any short-term dips. But hold on, 60% VGT seems like a lot of eggs in one basket, even for a risk taker like me.
You're right. Diversification is crucial even within a specific sector. Remember, VGT itself holds a basket of tech companies, not just one or two. But to balance things out, we wouldn't put all our remaining money into just one other ETF.
Makes sense. So with 40% of my $2,000 left to invest, how would I spread that between VOO and VIG?
In this scenario, we might allocate 25% to VOO, giving you a solid anchor in the overall market. That leaves 15% for VIG, adding a dash of that dividend growth magic to the mix.
So I'm basically building a 3-legged stool. A solid base with VOO, a growth kicker with VGT, and a steady income stream with VIG. I like the sound of that.
Exactly. It's all about balancing those different elements to create a portfolio that aligns with your goals and risk tolerance. Now let's flip the script. Imagine you're closer to retirement, say in your early 60s. How would that change our ETF allocation?
Well, if I'm nearing retirement, I'm probably less concerned with aggressive growth and more focused on preserving my capital and generating income. I wouldn't want to see my nest egg take a big hit right before I need it.
That's a smart perspective. In this case, we might shift gears significantly. Instead of 60% VGT, we might dial that back to something like 10% or even less. Remember, the tech sector can be quite volatile, and you wouldn't want to expose a large portion of your retirement savings to those fluctuations.
Okay, so we're drastically reducing the tech allocation for our retirement-minded investor. What about VOO and VIG? How would those proportions change?
For someone in this stage of life, we might bump up the allocation to VOO considerably, perhaps to 50% or even more. That provides a stable, diversified base for the portfolio, reflecting a lower appetite for risk.
So VOO becomes the main ingredient in our retirement sundae. What about VIG? Will we still keep that in the mix?
Absolutely. In fact, we might increase the allocation to VIG to something like 30% or 40%. Remember, VIG focuses on companies that consistently increase their dividends, which can provide a reliable and growing income stream. That could be particularly appealing for someone in retirement who's looking for a way to, supplement their income.
I see. So VIG becomes our income generator in this scenario. It's like we've flipped the script completely from our younger investor example. And instead of chasing high growth, we're prioritizing stability and income.
Exactly. And that highlights a crucial point. There's no single best ETF allocation. The optimal mix depends entirely on your individual circumstances, goals, and risk tolerance.
So for our listeners who are saying, okay, but what about my situation? How much should I put in each ETF? What's the best way for them to figure that out?
The key is to do your research. Understand your own financial needs and goals, and consider your comfort level with risk. You can explore resources like the Motley Fool's website, read financial blogs, or even consult with a financial advisor if you need personalized guidance.
It's like we're giving our listeners a map and a compass, but they get to choose their own destination and chart their own course. But hold on, we've been focusing on these specific proportions. 602-515 or 105-40. Are those the only options? What if I want to do something totally different?
Those are just examples to illustrate how different risk tolerances and life stages can lead to, different asset allocations. There are endless possibilities. You could split your $2,000, Emily, between the 3 ETFs, go all in on one if you're feeling bold, or come up with any other combination that makes sense for you. The important thing is to have a rationale behind your decisions and to be comfortable with the level of risk you're taking on.
So it's not about following a rigid formula. It's about understanding the tools, knowing your own financial landscape, and making informed choices that align with your goals.
Exactly. And remember, your investment strategy isn't set in stone. As your life changes, your financial goals evolve, or the market throws you a curveball, you can always adjust your allocation.
Okay, that makes me feel a lot better. It's not like I'm making a life or death decision here. I can always tweak things as I go. But let's say I've done my research. I figured out my risk tolerance, and I've come up with my perfect ETF allocation. What's next? Do I just buy those ETFs and forget about them?
While the buy and hold strategy can be incredibly effective, it doesn't mean you completely ignore your investments. It's important to periodically review your portfolio, assess your progress, and make adjustments as needed.
So it's not a set it and forget it situation. It's more like tending a garden. You plant the seeds, but you still need to water them, weed them, and maybe even prune them a bit to ensure they're growing healthy and strong.
I love that analogy. And just like a garden, your investment portfolio needs ongoing attention and care to flourish. But remember, you don't have to do it alone. There are tons of resources available to help you, from financial websites and blogs to professional advisors.
That's reassuring. It's like having a whole team of gardening experts on call to answer my questions and offer guidance. But speaking of guidance, let's get back to the Motley Fool article for a moment. It raises a really interesting point about the future of these ETFs. How might the landscape of these investments change over the next 10 years? What emerging technologies could shake things up?
That's a fascinating question, and one that highlights the dynamic nature of the investment world. Think about it. 10 years ago, did we have things like widespread AI adoption, blockchain technology, or self-driving cars? The tech landscape changes rapidly, and those changes inevitably impact the ETFs that track the sector.
Okay, so even if I'm following a buy and hold strategy, I can't just bury my head in the sand and assume everything will stay the same. I need to stay informed about the forces shaping the market.
Exactly. Continuous learning is essential. The more you understand about the factors that influence the market, the better equipped you'll be to make informed decisions and adapt your strategy as needed.
So it's not enough to just pick the right ETFs at the beginning. It's also about understanding the bigger picture, the trends, and the potential disruptions that could impact your investments down the line.
Precisely. And that's where staying curious and engaged comes in. The world of investing is constantly evolving, and those who embrace that change and continue to learn are the ones who are most likely to thrive.
So it's not just about picking the right ETFs. It's about cultivating a mindset of continuous learning and adaptation. It's about being an active participant in your financial journey, even if you're not day trading.
Exactly.
Uh,
And that's where the real power lies. It's about taking ownership of your financial future, making informed decisions, and adapting to the ever-changing landscape of the investment world.
Okay, that's a great perspective to keep in mind. But before we get too philosophical here, let's ground ourselves back in the specifics of our three ETFs. We've talked a lot about their potential, but are there any potential drawbacks or risks we should be aware of?
That's a great point. Every investment comes with some level of risk, and ETFs are no exception. Let's start with VOO, our S&P 500 tracker. While it offers broad market exposure and tends to be less volatile than other investments, it's still subject to overall market fluctuations. If the market takes a downturn, VOO will likely decline as well.
So even with a safe option like VOO, there's no guarantee of positive returns.
Exactly, and that's why diversification is so important.
Yeah.
Don't put all your eggs in one basket, even if it's a seemingly stable basket like the S&P 500. Now let's move on to VIG, our dividend growth ETF. One potential risk here is that companies can cut or eliminate dividends if they face financial difficulties.
Well, that's a good point. I was so focused on the idea of those dividends increasing that I forgot they could go the other way too. But isn't VIG designed to minimize that risk by focusing on companies with a history of consistent dividend growth?
That's true. VIG's selection criteria are designed to weed out companies that are likely to cut dividends. But it's important to remember that no investment is completely risk-free. Even the most reliable companies can face unforeseen challenges.
Okay, so even with VIG's focus on dividend stability, it's essential to understand that those dividends are not guaranteed. What about VGT? What are the potential risks associated with our tech-focused ETF?
Well, as we discussed, the tech sector can be highly volatile. VGT's value can fluctuate significantly, especially in the short term. Also, the tech landscape is constantly evolving, and there's always a risk that today's tech giants could be tomorrow's dinosaurs.
So if I'm heavily invested in VGT, I could see my portfolio take a hit if a major tech company stumbles or a new technology disrupts the market.
That's right. Investing in tech requires a certain level of comfort with risk and an understanding that change is inevitable. But that's also what makes it so exciting. The tech sector is where innovation happens, where the future is being shaped.
It's a high-stakes game, but the potential rewards can be enormous. But before we get carried away with the allure of tech, it's important to remember that investing is a marathon, not a sprint.
Absolutely. Don't get caught up in the hype or the fear. Make informed decisions, diversify your investments, and focus on the long term. And remember, knowledge is your most valuable asset. The more you understand about the market, the better equipped you'll be to navigate its complexities and achieve your financial goals.
Well said. So to sum it up, we've explored three powerful ETFs, VOO for solid foundation, VIG for dividend growth, and VGT for tapping into the world of tech. But we've also emphasized that there's no one-size-fits-all approach.
Exactly. Building a successful investment portfolio is about finding the right balance for you. Consider your risk tolerance, your goals, and your time horizon. Do your research, explore different options, and don't be afraid to ask for help.
And remember, investing isn't a destination, it's a journey. Embrace the process, stay curious, and continue learning along the way. But before we wrap up this part of our deep dive, I want to circle back to a question that came up earlier. How might artificial intelligence reshape the investment landscape in the coming years?
That's a question that's on the minds of many investors and experts alike. Could AI-powered tools become the norm for managing portfolios? Will they disrupt traditional investment strategies? Will they make investing more accessible to everyone? These are all fascinating questions that we'll explore in more depth in the next part of our deep dive.
Okay, so we're leaving our listeners on a bit of a cliffhanger here, but that's what makes this so exciting. The world of investing is constantly evolving, and we're all on this journey of discovery together.
Exactly. So buckle up, folks. We're about to delve into the fascinating and potentially transformative world of artificial intelligence and its impact on the future of investing.
Welcome back to the deep dive. Before the break, we left you with a question swirling in the air. How might artificial intelligence reshape the investment landscape in the coming years?
It's a question that has the potential to rewrite the rules of the game. AI is already making waves in countless industries, and the world of finance is no exception.
Okay, so AI is coming for our portfolios. But is that a good thing or a bad thing? Should we be excited or terrified?
That's the million-dollar question, isn't it? I think the answer is a bit of both. AI has the potential to make investing more efficient, more accessible, and even more profitable. But it also comes with its own set of challenges and risks that we need to be aware of.
All right, let's unpack this. First, the good stuff. How could AI actually make investing better for everyday people like me?
Imagine having a personalized financial advisor available 24/7 analyzing market trends, crunching numbers, and recommending investments tailored to your specific goals and risk tolerance. That's the power of AI. It can sift through mountains of data and identify patterns that humans might miss, potentially leading to, better investment decisions.
Okay, so AI could be like having a super smart robo-advisor in my pocket, constantly working behind the scenes to optimize my portfolio. But I've got to ask, wouldn't that kind of technology be super expensive? Would it only be available to, like, the ultra-wealthy?
That's a valid concern. But one of the most exciting things about AI is its potential to democratize access to sophisticated financial tools. As AI-powered platforms become more widespread, the costs are likely to come down, making these services available to a broader range of investors.
So it's not just about making the rich richer. AI could actually level the playing field and empower everyday investors to make smarter decisions. That's a game changer. But let's talk about the potential downsides. What are some of the risks we should be aware of when it comes to AI and investing?
One of the biggest concerns is the potential for bias. AI algorithms are only as good as the data they're trained on. If that data reflects existing biases or inequalities in the financial system, those biases could be amplified by AI-powered tools.
So if the data used to train these AI systems is skewed, the results could be unfair or even discriminatory. That's definitely something to watch out for. Are there any other potential risks we should be aware of?
Another concern is what's called the black box problem. AI algorithms can be incredibly complex, and it's not always clear how they arrive at their decisions. This lack of transparency can make it difficult to understand why certain investments are being recommended or why certain trades are being executed.
So it's like trusting a magic 8-ball to manage my money. I put my faith in the AI, but I don't really understand how it's working. It's magic. That's a bit unsettling. Are there any ways to address these concerns?
Absolutely. Transparency and explainability are becoming increasingly important in the field of AI. Developers are working on ways to make AI algorithms more understandable and to provide insights into how they reach their conclusions.
So it's not just about building these powerful AI systems, it's also about ensuring that they're fair, transparent, and accountable. But let's bring this back to our 3 ETFs, VOO, VIG, and VGT. How might AI specifically impact these investments?
AI could potentially influence these ETFs in a number of ways. For example, AI-powered tools could be used to optimize the selection and weighting of companies within these ETFs, leading to potentially better returns.
So instead of relying on humans to decide which companies to include in these ETFs, we could have AI algorithms constantly analyzing data and making adjustments to ensure the best possible performance. It's pretty wild.
It is. And AI could also be used to develop new types of ETFs that are more responsive to market conditions or that target specific investment themes or trends.
Okay, so AI could not only improve existing ETFs, but also lead to the creation of entirely new investment products tailored to specific needs or interests. That opens up a whole world of possibilities. But let's get real here. This all sounds very futuristic. Is this something that's happening right now, or is this all just speculation?
AI is already being used in various aspects of the financial industry, including portfolio management, risk assessment, and fraud detection. While it's still early days, AI-powered ETFs are already starting to emerge.
So this isn't just some sci-fi fantasy. AI is already making its presence felt in the investment world. But let's step back for a moment and consider the bigger picture. What are the long-term implications of AI for investors like you and me?
That's a question that keeps me up at night. Will AI ultimately empower investors by providing access to sophisticated tools and strategies? Or will it create a new divide between those who can afford these technologies and those who can't?
That's the crucial question, isn't it? Will AI democratize investing, or will it exacerbate existing inequalities? It's a bit of a double-edged sword. But one thing's for sure, we can't just ignore it. We need to stay informed, engage in these conversations, and shape the future of AI in a way that benefits everyone.
I couldn't agree more. The future of investing is being written right now, and we all have a role to play in shaping it.
Well said. So as we wrap up this deep dive into the world of ETFs and the potential impact of AI, what are some key takeaways for our listeners? What do we want them to remember as they navigate the ever-evolving investment landscape?
First and foremost, remember that knowledge is power. The more you understand about ETFs, AI, and the forces shaping the market, the better equipped you'll be to make informed decisions.
And don't be afraid to ask questions, seek guidance, and challenge assumptions. The world of investing is complex, and there are no easy answers.
But most importantly, remember that investing is a journey, not a destination. Embrace the process, stay curious, and never stop learning.
And that, my friends, is a wrap on this deep dive into the world of ETFs and the transformative potential of artificial intelligence. We hope you've gained valuable insights, sparked your curiosity, and feel empowered to take control of your financial future.
Remember, the future of investing is being written right now, and you have the power to be a part of it. Stay informed, stay engaged, and stay ahead of the curve.
Until next time, keep diving deep, keep exploring, and keep reaching for your dreams.